Welcome to another edition of the Education Series with D. Walter and Associates. Today we're going to be talking about personal insurance and what it is, how it works, when you should get it, why you get it, and the benefits. So, what is it? It is life insurance. So if you die, it is total and permanent disablement. So if you're not going to be able to work again, it is trauma or crisis recovery. If you get one of the big four, which are cancer, heart attack, stroke, or bypass surgery, among others. Income protection, as it suggests, it protects your income if you can't work. And then there's also business expenses. How does it work? Life insurance is a lump sum. If you die, you're diagnosed with a terminal illness, that is paid. TPD provides a lump sum generally if you've been totally disabled for 3 months, and it looks like you will be for the rest of your life. Trauma, crisis recovery pays a lump sum on diagnosis of one of the listed events. Income protection, it's up to 70% in most cases these days of your current income if you're unable to work due to any accident or illness. Business expenses pays up to 100% of your fixed business costs for up to 12 months. So that's as a general rule of 5 that are available and what they do. But more to the point, how do you structure things? So all types of cover can be owned and funded personally. Trauma, crisis recovery, and business expenses, they must be owned personally. They can't be in superannuation. Life, TPD, and income protection, they can be funded via your superannuation if you've got if there's cash flow issues that don't allow you to fund them outside of super, or it may even be a good idea to do the life and TPD through super anyway. You get a 15% rebate, so the premium is reduced. Income protection and business expenses, if you pay for them out of your own pocket, they're deductible at your marginal tax rate as a general rule. So when should you get personal insurance? So the best time to protect your current and future wealth is when you're young, fit and healthy, so before any medical issues arise. And then you have a look at the types and levels of cover you've got. When you might get a pay rise, so you've got more income to cover. You might buy your first house, so you might get an investment property. Have children. You might receive an inheritance, so you might need as much insurance anymore. Or you might have a major life event, so you might get married. You might get divorced. Incidentally, 100% of divorces start in marriage, so they go hand in hand. You might get a new job, or you might move from being a PAYG employee to self-employed. So there's a number of reasons why you would have a look at things, and we generally recommend every 12 months have a look at it. Now, why would you have personal insurance? Well, the first reason is your biggest asset is your ability to earn an income over your lifetime. So if you don't insure that, your entire financial plan can come crashing down around your ears if your income stops or is reduced significantly. Your life and TPD, most people have a financial plan so that they would like to leave their family or loved ones debt free. Depending on your stage of life, you might like to fund education costs for children. You cover off on your funeral, any other medical type costs, and there's a certain amount that you might leave as an income stream for the surviving members of your family. The trauma, crisis recovery, as a general rule, you'd look at 6 to 12 months of being unable to work. So you're going to be pretty crook for a while, but you're going to get back to your best. So it's really a lump sum to get you through that period. And then your business expenses is also your fixed business costs. So if you can fund those for 12 months, which it allows the business to continue running while you assess where you're at. So are you going to come back or not? Is the business need to be tidied up for sale, or is it just a holding pattern because you're going to be okay and come back? Our philosophy on the insurance side of things is we do needs-based advice. So we find out what you need, how much you need, what's the best tax structure, ownership structure, are you going to be able to actually get it? Like, are there health issues where you might find that you have an exclusion, or you might have you might have to pay more due to your medical history, and that probably leads into, is it affordable? So it's all well and good finding out exactly how much you need, but if it's not affordable, then we need to move into the tailoring of your individual plan. So once we work that out and we have the conversation around whether it's what you need, and if it's affordable, that's fine. That's an easy one. But if it's not, affordability for us is paramount. So you're better off having an affordable insurance plan in place than a beautifully sculpted, fantastic looking piece of paper that you can't afford. That doesn't really help anyone. So that's it in a nutshell, pretty much. Here's a little example I've thrown together for life and TPD of how you might work it. So a regular couple, 40 kids that are 6 and 8. You've got one parent who's earning 200,000 and one has just gone back 1-2 days a week to keep their eye in, so to speak. And the kids are still at primary school, so there's a little bit of a demand on their time. So they've got about 150 each in super, 50 in the bank, your car and contents. They owe $1 million. They've got 50 grand on car loans as well. They're looking at private secondary schools for the kids. Within a couple of years, the part-time parent is going to return to full-time. They want to repay the mortgage as quick as they can. Cash flow is tight with only the one main income and the $1 million mortgage, and they think they'll probably work to age 65. So what we'd sort of look at there's a funeral and medical costs are the final sort of expenses, if you like. Is you'd look at 50,000. Cleared their mortgage would be $1 million. It's about 40 grand a year for 6 years of secondary schooling at private schools. So that's starts to add up. So we get to around the $1.5 million mark before the real stuff kicks in, and that's how much income are we going to leave to the surviving spouse, or if you both happen to go, how much are you going to leave for the children? So if it's based on the current income, you'd look at the earning capacity over the 25 years. So it's about 5 million, or 625,000 for the part-time parent, or is it 3.125 million for the parent who returns to work and earns, say, 125,000. But if you look at an expense-based thing of, okay, they need 100,000 to live off with everything else paid, is it about $1 million on top of that? Does that get them through, the kids get through the end of school? And, their sum insured could be between 1 million and 6.5 million. Depends on what people actually want. So we come back to tailoring the plan, and we look at it and we work out what's understandable, what's fair and reasonable, and also what's affordable. So that's where your professional advisor comes in and works with you so you know what you've got, and you're going to be what's going to happen if this disaster were to occur. So, and then also where your professional advisor comes in, who do you insure with? So there's a number of different insurers out there. They have points of difference with definitions. Their premium rates are different, whether they're in the news or not. What's their claims history? What do they actually like to deal with? So that's where we come in, and we will tailor that and find the best fit for you. And if you want to know more, you know what to do. Our doors are open. Just shoot a message through, and we can organise a catch up. So thanks, guys. Have a great weekend. May your football team win if you're still in it. And I'll see you next week. We'll have a conversation around investment bonds. Cheers.